In today's video, I'm going to cover a couple of practical strategies for you to start investing, even if you don't have a lot of money to invest. Even if you have $5 to invest, this video is for you. Hey wealth builders, and welcome back to another episode of The Bemused. If this is your first time here, my name is Akiva, and on this channel we make sense of all things money for the bewildered and confused young adult. So this video is the 5th video in our Making Sense of Investing series. And if you haven't seen any of the videos before this one, I'll make sure I put a card right up here so that you can go and watch the series from the beginning if you want to learn more about how to start investing. In particular, I'm going to be covering micro investing and also talking about a couple of micro investing platforms like Acorns and Stash and Robinhood. And I'm also going to be talking about starting to invest in your retirement plan, whether that's a 401k or an IRA or other type of retirement plan. So if you're interested in that, make sure you stick around. So far in this series, we've covered what investing is. We've defined a bunch of terms that are helpful for you to know when you're getting started in investing. We've talked about several popular investment vehicles like stocks and mutual funds, ETFs, REITs. We've talked about how those things are taxed. And now we are going to get to the practical strategies. We're actually going to get it going and start investing with this video. So first, let's talk about micro investing. So what is micro investing? And it's basically what the name implies. It's investing micro amounts, very small amounts of money. And we're talking dollars, even pennies at a time. So why might micro investing be a really good strategy and a way for new investors to dip their toe into investing? If you want to start investing but you either don't have or don't care to invest large sums of money at a time and take that risk with large sums of money, this could be a good strategy for you. Also, if you find the task of putting aside money consistently to be a challenge for you, this could also be a good strategy for you to start investing. Now I'm going to talk about a few investment platforms that are really good for beginners. It includes a couple of micro investing platforms. And a couple of these platforms actually automatically debit small amounts of money and withdraw them from your account so that you barely even feel the burn of that money leaving your pocket. $5 here and $5 there can definitely add up over time and get you into the habit of investing. So now let's dive into 3 popular investing platforms that can be really good for beginners. I'm going to be going over how each account works, the investment options that are available to you with these platforms. I'm going to go over the fees, which are really important, and also highlight a couple of unique features that platform might have. So first up, let's start with Acorns. Acorns is a micro investing platform, and the most popular way that people use Acorns is using their roundup feature. So essentially, if you go to Starbucks and you swipe your Acorns linked credit card for $5.20, you can program Acorns so that when you have that transaction, they will then go into your bank account and pull out 80 cents to round that purchase up to an even $6. And they'll deposit that money into your Acorns account. And you can also set up automatic transfers where a set amount of money comes out of your account on a periodic basis, whether that's weekly or whatever schedule you set. In terms of investment options, Acorns keeps it very, very simple. Acorns has 5 preset portfolios, and these portfolios range from conservative to aggressive. These portfolios are made up of only a handful of ETFs, one representing each asset class. And again, if you don't know what an ETF is, make sure you head on back over to the previous video where we talked about the different types of investment vehicles, including ETFs. With Acorns, they really try to leave the guesswork out of it. So they'll give you a little quiz that asks you a couple of questions about your time horizon and your risk tolerance, and they'll recommend an ETF portfolio that they think will be best fitting your needs. Now, a couple of unique perks with Acorns. So Acorns has Grow Magazine, which is essentially their financial education resource. And they have, financial experts and professionals and different people who write articles there and share a lot of the things that we share on this channel. They also have a program called Found Money, which is essentially like their cashback program. And with that program, they partner with different companies to get you certain deals. For example, if you book a hotel stay at Hotel X through the Acorns app, you can get 10% of your transaction posted into your Acorns account. Now, in terms of fees, if you're a student or you're using a student email, let's be honest over here, Acorns is absolutely free. For those of you who don't have a student email address to use, it is $1 per month for their standard taxable brokerage account. Now with micro investing in particular, the cost, even though it just sounds like a little bit, $1 a month, it could be pretty cost prohibitive, especially if you're only using the roundup feature where you're probably only putting in $5, $10, $15 a month into your account. That's really a lot to pay in fees. And you may end up paying more in fees than you actually make in returns. And that's definitely not the goal. Acorns also has a couple of other products outside of their main investment account. So for $2 a month, you can have Acorns Later, which is basically their IRA. And for $3 a month, you can get the taxable account, the IRA, and Acorn Spend, which is basically like their checking account banking product. Next up is Stash. Stash is another popular micro investing platform. So similar to Acorn, Stash also has a roundup feature, and you can set it up to just have automatic periodic transfers into your Stash account. They also do what they call Smart Stash, which is where they only transfer money into your Stash account based on their algorithm and when they feel that you can afford to have that money come out of your account. On their website it says, and I quote, "We'll track your spending and earning patterns to set aside spare cash for you, only when you can afford it." In terms of investment options, they have way more investment options than Acorns, which can be good or bad depending on how you look at it. Stash has over 200 investment options, including stocks and ETFs. Their account minimum is only $5, which makes it really good for micro investors, and they allow you to have fractional shares in your accounts, which we've discussed in previous videos in this series as well. One unique perk of Stash is that they have Stash Learn, which is basically their financial education equivalent platform. Now because they have so many investment options, when you set up your account, they'll give you also a small quiz to help gauge your risk tolerance and all that great stuff and help determine a portfolio for you. But of course, because they have so many investment options, you don't have to go with what they recommend. You have the freedom to build your own portfolio, and you can take as much or as little guidance from Stash as you want. Now for the fees. Stash comes in at $1 per month, just like Acorns, for their standard taxable brokerage account. Which again, depending on how much money you're planning on investing and how much that is planning to grow, don't really know if that is worth it for some people. And I didn't see anything about like a free student account or anything like that from my research. But if any of you have seen something different, definitely let me know in the comments below. And that $1 a month also gets you debit account access. For $3 a month, you can get not only the investment account and debit account access, but you also get their IRAs. And for $9 a month, you just get a whole bunch of stuff that you probably don't even need. So we're just gonna skip right over that. Now the third investing platform I want to talk about is Robinhood. So Robinhood isn't necessarily a micro investing app, but it could be good for beginners because one, there are no commissions for trading in the account, and two, you can buy fractional shares, which is always great when you don't have a lot of money. Robinhood has a myriad of investing options, including stocks, ETFs, even cryptocurrency, for crying out loud. Now in terms of fees, at the surface, it might look like Robinhood is absolutely free. You can trade and do whatever you want. However, there are a couple of fees that you might want to be aware of if you're going to open a Robinhood account. For example, they charge a $75 fee if you want to transfer your account to a competing brokerage firm. So now let's move on to retirement account investing, which is another great way to start investing, and is the way that I started investing, through my 401k at work. Now in this video, we're not gonna go through like the mechanics of how these plans work. We're actually working on a video right now to be posted sometime next month about retirement plans and the way they work, the differences between a 401k and Roth 401k, which not a lot of people talk about on here, Roth IRAs, and regular IRAs. So if you want to see that video, make sure you subscribe and turn on that notification bell so that you don't miss a single thing. So let's start with 401ks, because that's what the vast majority of people have access to at their jobs, either 401ks, 403bs, or some type of equivalent. So what do you invest in? I personally started with just the fund options that were available to me. In my 401k at work, we had 33 fund options, and that included basically mutual funds and target date funds, which most of them are mutual funds as well. We also have the option of what's called a brokerage link, where basically it gives you access to like a bunch more investment options. But if you're new, you may or may not find that overwhelming and just want to stick to the funds that are available through your standard 401k options. So let me talk about target date funds for a moment. A target date fund, also known as a life cycle fund, a dynamic risk fund, or age-based fund. You'll hear all those kinds of terms when you're talking about a target date fund. It's essentially a pooled investment vehicle, and the goal is really to make things simple for the investor. So if you say, based on my age, I should be retiring in the year 2050, for example, the company will most likely have an investment option that says whatever fund 2050, and that asset allocation in that fund is gonna basically go from really aggressive, like mostly stocks and equities, and over time, it'll automatically start to rebalance and change the allocation so that it gets less risky as time goes on, you get closer to retirement. So target date funds can be a really easy solution. However, the big downside is that these funds tend to be pretty expensive in terms of their expense ratios. If you look at your 401k offerings, look at your target date funds, most of the times they have higher expense ratios than if you were to choose other mutual funds or other types of investments. The allocation may also not be exactly what you want, but if you find investing overwhelming, target date funds could be a good place to start. I know when I started my 401k and I was still learning about investing, that's exactly where I started, was in a target date fund. And then once I learned more, I got out of that target date fund and started picking a couple of mutual funds for myself. Something is better than nothing. So once I started learning more about investing, I decided on the asset allocation that I wanted for myself. And so my asset allocation in my 401k is actually 100% equities. And I wanted to have a mix of US stocks, international stocks, and emerging market stocks. So basically what I did was, I think some people call this the 3-fund portfolio. I found a fund that captured the US market, I found a fund that captured developed international, and I found a fund that captured emerging markets. And we haven't really talked much about investing industries and sectors in that way. So if you guys want more information about what those 3 things I just said mean, let me know in the comments below. And here are the 2 things I looked at when determining exactly which funds I wanted to use to capture that part of the market. Firstly, I looked at the expense ratio. I wanted to make sure it wasn't high. So lower expense ratio, like we talked about before, is definitely better. Secondly, I looked at the performance of those funds just to see if they were performing in line with their benchmarks, and we've talked about benchmarks also in a prior video. So if those 2 boxes were checked, that basically narrowed down the pool of the funds that I was going to choose to put into my 401k. Now, IRAs, of course, will have lots more investing options typically, and I would narrow down your options in the same way, looking at the benchmarks, looking at the expense ratios, and making sure that those are capturing the types of assets you want to invest in. So if you want to just invest in all US stocks, that narrows down your search right there. Look for ones that have the lowest expense ratios and also are performing in line with their benchmarks. So what are some other ways that you guys think beginner investors can begin to kind of get their feet wet with investing outside of maybe a retirement account or micro investing? Leave your ideas in the comments below. Make sure you subscribe and hit the bell, because in our next and final video in this series, I'm actually going to be having a very special guest talking all about impact investing, which is something that I find super exciting. So if you want to see that video, make sure you got that notification bell turned on. Thanks so much for spending this time with me, and I'll see you in the next video.